Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, August 28th, 2015. This video will be the first of several that I plan to do today and possibly into the weekend because there are, as I mentioned this morning on the site in the morning update, there are so many relevant market developments right now in currencies, commodities, obviously the U.S. markets, international markets, and to cover it all in one video is just not possible to really try to get all the details. So what I wanted to do first is look at the near-term outlook, what's relevant right now, most important. I think this video will be good for both active traders that have been trading this market this week. As I mentioned, it's been very, very conducive to short-term trading, especially intraday day trades, shorting off using the 1 to 5 minute charts. Also looking at, as we've approached some resistance levels from below on the daily chart. There's been, like I said, a lot of very lucrative trades with especially in the Qs. That's what I've been focused on. I always watch all the major U.S. indices when I'm trading, but my preferred proxy right now is QQQ, and that is just working phenomenally. It's backtesting gaps from above and below within pennies and reversing sharp reversals, really respecting short-term trend lines. So it's just been, as I said, at least for this week, a great trading vehicle, and that may continue forward. But for the longer-term investors, what I wanted to look at here is where we are as far as a couple things. We'll look at some Fibonacci retracements, we'll look at overhead resistance levels, and a couple other things that I'm looking for here and where I think we might be headed. So starting out here on the NDX, let's take a look. Let's put some trend lines up. This chart's a little bit busy, but essentially what happened, you see the divergent high. We had a divergent high, prices moving up in this channel. We kind of treaded sideways, flat to sideways all year. Maybe this slight, I have this down, this trend line here, a slight uptrend line with this parallel line. So this was sort of a channel, and that defines the trading range that we were in for most of this year. Prices broke below, and of course we all know what happened. So we also had the bottom of that trading range, or a similar one, defined by these two trend lines here. I mentioned the other day that we were at support, and we did. It's hard to see on here because these are daily candlesticks. It's shown on the 5 minute chart. We had several pullbacks from that level, and then prices finally broke above and then shot up quickly to this next one. So what I'm referring to here is this horizontal line and this one here. We're probably better off if I take a look at the Qs, because I know that's what most people trade, either the QQQ or some derivative of it. And you can see those lines very clearly. So that's where we are right now, and this is what I wanted to point out. The market has just a ton of overhead supply. Supply meaning resistance. This area, if you really go back to the beginning of the year, at least February, this is where anybody who had put money into a mutual fund, 401k, IRA, individual stocks, this is where they were buying. So those people are underwater, and this is how technical analysis works and why it works. That big drop, obviously people woke up to that even after a bad day on Friday where they started to become underwater. That's when support broke, and I warned, when that level went, that we'd have a swift move down, which we did. We certainly did. And that's because it's a well-watched support level, especially on the SPY. It's even a little better defined. So, what happens now is you have people who had bought and now are like, whoosh, dodge that bullet. I'm back to where I was or close to it, at least the bottom end of that range, and you would expect to see some profit taking. Now, if we continue to push higher and right up through these support levels, there's numerous support levels resistance levels on this chart. This is the long-term downtrend line, or uptrend line right here, which was broken in the Qs. It goes back for years. You can barely make out. I have it dimmed down a little bit. There's a red line here. That's the 200-day exponential moving average, a very well-watched level. So we have prices, just below back testing, just shy of back testing the recent breakdowns of these long-term uptrend lines. We have prices back testing the broken 200-day moving average, and as I'll show in a minute here, we have just about every major index as well as most key stocks at Fibonacci resistance. So, some traders trade purely off support and resistance. Some really incorporate mostly moving averages into their trading. Others, I know some traders exclusively trade off fibs. I like to incorporate all three. And so what I'm looking at here is a cluster of resistance that the markets are at now. And that is why I believe that even if my analysis proves to be wrong, and the market just continues to power up on through all this overhead supply and these resistance levels that I've mentioned, to add back or initiate a new short position here is objective, because your downside risk, let's just say you shorted the Qs, 105, 106, right about where we are, and you wanted to stop out once we take out the 61.8 fib, which I'll talk on in a second. You come back and close back above this trend line, especially 2 daily closes back above it. We start moving through all that overhead resistance. So what are we looking at here? That's right where I'm holding my cursor now. 108.55 is only 2%. Let's go up here, 3%. So you go up to about 109. You're looking at about a 3% downside risk if stopped out. And if what I think may happens, which is a move down to retest and quite possibly take out those lows, look, that's 20% below. So to take a risk 3% to make 20 or plus is extremely objective in my book. So that's why I or nobody knows for sure what will happen from here, but from a pure risk to reward perspective, shorting here, adding back shorts is certainly objective. And if you're not the type to short stocks and you're a long-term investor listening to this wondering what to do, you wouldn't necessarily want to sell here. If you held and rode through this, we may power back up. But to place some stops below, and I'll try to get down to the intraday charts and show you where those stops would be, would certainly be prudent. And at the very least, I think if we go back down below here, let's say another 5-6% or so drop in the Qs. Again, I have to zoom into the intraday charts to really hone down those levels. But if we move back this far, we're probably going to go have another leg down. So at the very least, you dodged a bullet that day, great. But now it might be time to set some stops and minimize your downside loss. So if we do take another leg down, you don't give up a lot of profits that you've made over the last couple of years. Okay, in any analysis of the market, even though I'm focusing primarily on the Qs, the NASDAQ 100, you'd be remiss not to take a look and see what the S&P 500 is doing, as well as the small and mid-cap indices as well. But what I have here, this is a pretty solid resistance, former support, resistance level now at about 1990. You see numerous reactions here. That 1990 level contained all these drops. It even had just one day break below and then managed to very impulsively snap back above there. That 1990 level was also the reaction highs that capped the market back here in July of last year. You managed to break above it, couldn't hold it, fell, and that was a very, this is a key level. That's a false breakout. I mean, in breakouts, whether they're bullish or bearish, when they fail, you usually get a violent reaction the other way. So that helps validate that level. The bulls tried to take that at the time, couldn't hold on to it, and then boom. So either way, I put a lot of emphasis on this 1990 level. Now, if that does get taken out, what happens? Well, we have this, this cluster here that went on for a few months, this trading range, that overhead supply. And so I think it'll be a tough road for the S&P 500 to climb back up if it does manage to move back up to my next resistance level, which comes in here, call it around the 2040. I have a resistance zone from about 2040 to 2050, 52ish. You can see the numbers there. So again, there's a range, and that is a super solid resistance area in my opinion. So, in the bullish case, if we manage to continue to power up in the coming weeks to even months, and we get here, the market's going to have one heck of a time getting over this. This is a a year long. This is over a year's worth of trading here. So in my opinion, and I'll just say it, I think that the odds are very likely that we've begun a bear market. I don't mean to be dramatic by that. We're not going down to the 2009 lows or anything like that. At least that's nothing indicating that at this point. But bear market is simply defined by a drop of 20% or more off the highs. And so where did we drop so far? The highs were about right here. Try to pinch that candle. And, so what is that? I'm looking to my left at the bottom, a 12.5% drop. So this is just a correction, which is defined by a drop of 10% or more. And so as I said, numerous things factor into this. Like I said, all the long-term bull market uptrend lines on every major U.S. stock index has been broken, clearly broken. We're trading below those trend lines. My intermediate and short-term trend indicators are on sell signals, although my longer-term trend indicators are not yet, but are very close, and I will cover that in another video. So most importantly now, we are at resistance in the SPY, even if we climb higher. Both the SPY and the NASDAQ 100, as well as the mid-caps and small caps, have a lot of work to do. I will say this, one more point on this, and I'll get off the S&P 500 chart. That 1900 was a key level, and 1990, I'm sorry, was a key level, and we broke above it. And once we finally got above it, it was impulsive, but we came back down and back tested it several times. Had we just broken out, come up here to this level where I have this next support or now resistance zone and traded just as we did over here. In other words, if you erase all this, if you take this few months of trading in that would be a thin zone. And then my expectation, I would be much more open to going long and being bullish, because that would essentially be similar or akin to a gap. You would have a very thin zone here, and then prices could move up quickly. And it is, again, still a possibility. You look at the volume at price histogram bars over here. It is somewhat thin because there was, only a few months of trading, but there were quite a few trades. So either way, like I said, I think it has some work to do. Possible the S&P can push up that far, but I have the Qs, which, in my opinion, that's the tail wagging the dog, is the NASDAQ 100 right now. And so I'm much more, as far as shorting any broad indexes or trading, that's what I've been trading. I have no interest. The SPY has too many energy stocks and things that are beat down and have limited downside, whereas I think the Qs, as I've stated, biotechs, technology, those are some of my favorite sectors right now on the short side with a lot of potential, and that's what the NASDAQ 100 is chock full of. So there it is. That's resistance levels. Now let's take a look at fibs real quickly. Here's the SPY, or I'm sorry, the S&P 500 still, and a lot of traders, will use these Fibonacci retracement levels. So if you don't know what they are, essentially the way I use them is on retracements. Typically you'll see retracements reverse at any of these key levels, the 38.2, 50%, or the 61.8% retracement levels. So far we've only retraced about halfway between the 38 and 50% retracement. And any normal counter trend bounce, you will usually stop at or between any of these lines, sometimes slightly overshooting the 61.8. I did the fibs on the previous bear market. I think I was looking at the NASDAQ 100 last night, and if I recall, every major counter trend bounce in the bear market from 2007 into 2009 retraced just over the 61.8. So that's not a line in the sand to me, but once we get well above that, that is usually where I concede or assume that this is not a counter trend bounce, merely that was a correction in an ongoing, we're going to go on to make new highs. So at this point I am viewing this that we are in a new downtrend, and if so, my expectation would be, as most traders who use fibs, that we will not exceed go much beyond the 61.8 retracement level. So another way to put this is, as impressive as the rally might have seemed in the last few days to some, or is for those of you who are bearish, it might be dejected because the markets seem to just going up several hundred points a day. That's nothing. In other words, the move up is completely and is almost always directly proportional to the move down. So if we look at how swift and sharp this move down was, you would expect an equally violent reaction in the other direction. Just look at this drop in the SPY over here in the S&P 500, and then look at the move up. Look at this drop. Now look at the move up, and look at the move down. That is normal in the stock market. So, to expect that you drop, what is this? How many points? Several hundred, a couple hundred points on the SPY, and not to see, a rebound. Again, put it in percentage terms, and that's simply telling you here that we've only retraced just over a third, less than half of the move. That's off the highs. If I do the fibs here, it's obviously, from the point we fell off, we've retraced a little bit more, but we're still well within and even quite below the upper end of the range of a typical retracement, at least on the S&P 500. So that's that. Now let's look at the two things. Let's take a look at the Qs. Now the Qs are deceptive, and they're deceptive because this, what you see in the QQQs, this is a correct candlestick. Most charting platforms you use will probably have the same lows because there were actually a couple trades that took place. But what happened is there were quite a few mini crashes in stocks and ETFs in that morning. And by mini crashes, there was price irregularities. In other words, what I mean by that, well, simply the NDX, which is the index that holds or tracks all these stocks, did not go down by as much as the Qs. The NDX, as you can see here, dropped, yeah, well, let's just say it from the highs. That's easy to do. I can capture the highs. So NDX dropped roughly, I'm looking to the left, 18, we're down about 18, 19% almost, and we go to the QQQ. Let's grab the high. Got to get this out of there. Grab the high, go down to the bottom, and there's 26%. That extra 7% was pricing irregularities, and that was just due to the large order imbalances at the open, combination, maybe the high frequency trading machines, maybe some errors, that the exchanges couldn't handle all the trades in such short order. In other words, those were opening imbalances, and they only lasted for a minute, couple minutes or so, or even seconds. As you know, everything snapped back up. So I don't want to spend much time on that other than to say that if you are a trader of the QQQs and you are someone who uses fibs, you're looking at this and you're saying, wow, this is a heck of a retracement. The Qs have now, gained, well exceeded the 61.8. That is not the case. The NASDAQ 100 is the index it's supposed to track, and there was a flawed job. 99.999% of the time, the Qs track the NDX nearly perfectly, and that 1/1000th of a percent the time that it didn't was the other morning for just a few seconds. So again, here we are on the NDX, the NASDAQ 100 itself, and we're looking at a prices just under that key 61.8 Fibonacci retracement level. So far, nothing more than your run-of-the-mill healthy counter trend bounce to what could be another move. And here's a scary thing. If this is an ABC move, a lot of times the markets is, moving these ABC moves. You have the initial thrust down, counter trend bounce that retraces, 38 to 61, 62%, and then another down. It's likely those moves are usually, again, proportional. So you're going to see, we could very easily see, and this is what I'm trying to keep my options open for. It's hard to bet it too hard with this kind of volatility, but another very sharp and fast move down that catches a lot of people off guard. So just keep that in mind. In addition to the 61.8 fib, which is resistance, I already covered the horizontal, the price resistance levels on the Qs. You can see it clearly here on the NDX. That white line, if you look at the horizontal line formed by the crosshairs, is exactly on that 61.8 fib. My experience trading, that's not mere coincidence that those levels line up. I could sit here and talk on it for hours, but I won't. I just will say that I don't think that's coincidence at all. Take it for what you think it is, but the bottom line is that is a level a lot of traders watch, so we're there, resistance. The fact that that's horizontal resistance is undeniable. So many reactions off that level and the reaction high back here. And then you have the 200-day moving average, the 200-day EMA, and that is a level watched by many, many traders. And now we're back testing that from below. So triple resistance. It doesn't get any better than that. As I said, I may be wrong. This market may be blasting higher, and if so, it certainly has its work cut out for it. I think the risk of an explosion, another, seeing the market climb 4 or 5% a day for the next week, I would put that probability at a lot closer to zero than I would 100%. And that's why I think, shorting here, whether you're stopped out for a minimal loss or get a big gain, I think it's very objective. In other words, the downside risk is minimal compared to the gain potential. So that was the fibs. We talked about the Qs, the NDX. I already covered the SPY, I believe. Let's see. Okay, let's just start zooming down in time frames here to try to time things a little better. Take a look at what, some of the things I'm seeing. This is a 60-minute chart of the NDX. This is just a trend line that goes back a little ways. You can see that going back. You got to go back in time quite a bit. So let's just forget about that trend line now. It doesn't matter. We broke gap below that. You can see the resistance here. There's actually a gap right there. So again, horizontal resistance, everything else. Now, if we are in a new downtrend, and even if we're not in a big move like this, when the market, we're clearly in an intermediate term downtrend. My intermediate term trend indicators were on sell signals, were bearish before the big drop on Monday. So and as I mentioned, despite the strength of this bounce in the last few days, all my short-term trend indicators that I use, I won't get into all the details on those right now. Believe it or not, and it surprised me, they remain bearish at this time, still on sell signals, and solidly so at that. And that's just from the magnitude of the move down we had, and again, how relatively small, if you will, the retracement has been, considering the scope of the move down. So if that is the case, and we are, in a new downtrend, one of the things I like to look for before changing my positioning to a more bullish bias and looking for a more meaningful bounce, meaning something that will last more than a few days and something that will likely exceed that 61.8 retracement, is positive divergence. I don't even see, and I should clarify, on the 60-minute chart, and I don't even see anything remotely close to resembling that. We don't have any positive divergence. Some traders might say, oh, well, sure, this is making, the RSI making a higher high. And but that's not the case because prices are making higher highs. So what we need, if I can draw it out here, let's do that. Oops, excuse me. All right, I have to move this over here. Essentially, in a nutshell, what I'm looking for, ideally, again, I'll have to adapt, would be another thrust down that takes out the previous lows. And in doing so prices put in a lower low, and if it happens soon, as I suspect, imagine I'm using a curved line. I've got one down here in the screen draw tools. I just don't know how to use it. So that would be the MACD, and then we'd reverse. Prices would move up. The MACD would curl back up, and then at that point I could draw, as well as the RSI, and both the RSI and the MACD putting in higher lows against prices making lower lows, and then we'd have bullish divergence. This is when I would be going from a fully, net short position to net long for a multi-week or at least a multi-day bounce. So that's something I'm looking for. Just to kind of put how distorted the Qs were in perspective. I mean, that move down just distorted the charts. This is the same 60-minute chart that I was just looking at on the NDX. See how squished all the price action is? That's because of that, that extra long candlestick tail due to the a couple prints that happened down here in the early right after the opening on Monday. So again, when Qs, S&P 500, SPY, that's what I'm looking for. Ideally, another thrust lower, make a divergent low, and at that point, get out of the shorts and start looking into some longs. Okay, now we're zoomed all the way down to the 5-minute chart. I think we'll be able to wrap this video up here. Let's see. As I said, we're looking at the Qs because that's what I'm trading. From this point, the erratic price action is pretty much, there's some big swings, don't get me wrong, but these the charts have now become clear. So what I'm doing is I'm zooming in. I've got to get rid of that huge candlestick from Monday that distorts the charts. So as I mentioned, what happened is right after that initial opening reaction, prices shot back up here, and then things normalized, so to speak. Again, there's still a lot of volatility, relatively speaking, but you got to get rid of that stick. And so once prices normalized, shortly after the opening bell, that became sort of the floor, which we went up. We hit, as I mentioned earlier, that lower resistance level that we were looking at on both the SPY and the NDX. We hit that. I pointed that out as resistance. There was a gap also, if I'm not mistaken. Yeah, there was a gap that we went up and hit, and I mentioned that. It's off to the left of this chart, but I said that that gap would be most likely our first resistance level, which it was. So the market pulled back, came back, hit that, made a reaction low where prices stabilized, went back up to that gap again. I mean, this is what I call just perfect textbook technical analysis. Went back down again, gave you another opportunity. You go short here, go long here. Then there was this downtrend forming. Reluctantly, I didn't catch that till afterwards. I know I took a pot shot at another short here the other day. Adding back swing, and I decided to actually keep that, which I have, and then I added again here yesterday up as we're now at these key resistance. So just in the last 2 days, I've become quite a bit net short, still being a little cautious, keeping things a little light, but I'm looking for the best setups. But as far as broad markets, I'm only trading the Qs, and then I have a lot of individual trades, and I'm also long some other stuff, mainly in the commodity arena. So this is the chart I posted this morning, and you could just see how well prices have acted. And once we took out that downtrend line, which again I have to go back, I hate the fact this candlestick here distorts this chart. You can see how well prices behaved that. I mean, it was a couple dozen, or at least a dozen reactions off that level, and then a breakout, and boom, off we go. And now look at this, we're just hitting that resistance. So to be short here, it wouldn't surprise me to see a little pop. There is another level. There's a gap back here. That's why I have that upper line. If you can just make it out on the left of this chart, there's a gap. So this is the upper end of the resistance zone. This is where I become concerned. Not so much intraday, but more closing basis. I'm talking on the swing short positions. But now I'll end this video by saying this is where, if you are long or if you're looking to catch another thrust down, if we do get one, as I just mentioned, as a possibility, this level right here. That's 97.88, where I have the line drawn to be safe. Give it a little bit. Sometimes the market makers, the powers that be, like to run things down. And the big boys on Wall Street, the big banks, the big institutions, they have enough money to do it. If they can get it, the market gets down here, they can take it down. What they do is they try to pop your stops. They know that, gosh, there's got to be a gazillion stops on traders right, sitting right below that. So, they might take it down. But if you see, a 60-minute, especially two 60-minute candlestick closes below there, and the bottom may fall out if that level gets taken out. You may, if you're waiting for two 60-minute closes, that's 2 hours. Prices could be down here. You saw how fast they fell the other day. I just wanted to point that out. That's where you may want to rethink your longs if you've been buying this dip, buying Apple, Google, the same things that everybody else is buying. That's where you'd probably want to exit. And if we look at the SPY, I would say that level is, I haven't marked up the chart because I've been trading the Qs, but it's pretty well defined. There was one little reaction there, so we'll call it 188.40. You could wait to see that reaction low around 187.11 go, but once that happens, my thoughts are we're going much lower, and we're going to go there very fast. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.